Matt Philo, why do I want to own high yield now? Markets are edgy. Do I really want to stretch for yield?
Well, treasury rates are quite low, Greg, and as manager of the Mainstay High Yield Corporate Bond Fund, we think there's good value in high yield. There's just a tale of two markets, one that's quite investable and quite attractive, and one that is quite dangerous. So it's a pretty bifurcated market right now. But a broad high yield index is yielding roughly 7.5% today, and relative to a very low treasury rate, that's about a 6.8% premium. And that's attractive yield if you have a disciplined investment process to control default experience.
In which sectors are you finding the, quote, safest high yield right now?
Well, we're invested across most sectors to some degree, and safety is a theme throughout the portfolio, not from a top-down judgment, but that's how our bottoms-up process has led to the portfolio to be positioned. Some of our larger sector investments happen to be on a bottoms-up basis in healthcare and energy and automotives.
You're big in energy. How will this affect you now that the price of oil has been dropping?
Yeah, people act like there's a collapse in oil prices, but clearly at $90 a barrel, oil is still relatively high, and we don't need even $90 oil. At $60 oil for our conservative holdings in the energy sector would still make them relatively easy on an asset coverage basis, which is the single biggest key to our investment process.
Let's talk about two issues in your portfolio, starting with building materials. What do you like about this one?
Well, building materials I would classify as a higher quality, high yield issue. They are the largest roofing products supplier in the U.S. based in New Jersey, and it is only 2 times levered and generates 20% free cash flow relative to its gross debt, which is very significant. And it's not as cyclical as people might perceive, because 85% of their roofing products go into the replacement market. And if you've ever had a leaky roof, that's not very deferrable.
You also like Texas Industries. They're in the cement business. Tell me why you like this issue.
Well, with Texas Industries, we're getting into a higher risk credit, and one that on the surface people might say, why would you own a cement manufacturer at this point in the cycle? And the answer is asset coverage. And so these bonds yield about 9.5%, trading a bit below par. And we are the only debt in the capital structure, and our covenants prevent being primed by a lot of much secured debt ahead of us. And we think we have upwards of 3 times asset coverage, because the cement plants are 2 in Texas, 1 in California, and they are very cost competitive, and the value is very definable. So we think they're worth over $1.5 billion. And while this company is 10 times levered now, using a little cash, these assets are very attractive to outside buyers. So there's an Egyptian billionaire, last name Sawiris, who has over a 20% stake in the public equity. And so we know there's a cover bid for the assets, and it would be a very unlikely scenario where this company ever ran low on liquidity. And so that's a riskier portfolio holding.